Have you ever stopped to think why some investors seem to live in a completely different reality? While the economy in their country is in crisis, inflation is rising, and interest rates are eating away at purchasing power, they continue expanding their wealth, buying assets, traveling, and living with peace of mind. It is not magic, it is not luck, it is strategy. And one of the most powerful, least discussed strategies is investing beyond borders, in assets outside your home country. Most people keep all their money trapped in one single country, one single currency, and one single economy. It is like building a beautiful house on top of a cliff that is slowly eroding away, hoping the ground never gives way. But history shows us that economies rise and fall, governments change rules overnight, and currencies can lose half their value in just a few months. The investors who thrive understand this and play on multiple fields at the same time. They do not limit themselves to their own backyard. Today, I want to show you why international investments can be your shield and your sword, and how to start taking advantage of these opportunities in a practical, strategic way. When your money is entirely in domestic assets, your financial health is tied to the mood of local politics, the performance of your local economy, and the value of your currency. By adding foreign stocks, funds, bonds, or even real estate, you reduce dependence on a single market. It is like planting crops in different regions. If one suffers a drought, the others keep producing. The best opportunities are not always in the richest economies. Some of the fastest growing countries are in Southeast Asia, Latin America, and even parts of Africa. They often have young populations, expanding consumer markets, and industries with explosive potential. By the time the average investor notices, the largest gains are already in the hands of those who entered early. If your currency loses value, but you hold assets in US dollars, Swiss francs, or Singapore dollars, your wealth can even rise in nominal terms. Large companies and private investors have used this technique for decades to preserve value. Today, investing internationally is far simpler than it was 20 years ago. You no longer need to open complex accounts overseas or travel to sign documents. International brokerage platforms allow you, with just a few clicks, to buy shares in a Japanese company, Canadian government bonds, or a Singapore real estate fund, all without leaving your city. But convenience does not mean zero risk. Many people get excited about a hot tip, buy foreign assets without research, and then are shocked when prices drop. The key is not speed, it is strategy. The first step is knowing exactly what you want: growth, stability, or income. If you seek rapid growth, emerging markets may be ideal, but expect more volatility. If you prefer stability, focus on developed economies and strong currencies. Many experienced investors combine both to balance potential upside and safety. The second step is understanding economic cycles. Not all countries are in the same phase at the same time. While one is in recession, another may be booming. Investing in sync with these cycles can turn risk into opportunity. The third point is to never underestimate currency impact. You could have an asset that rises 15%, but if its local currency falls 20% against yours, you lose money. This is why many investors use currency hedged. If you are already seeing how this strategy can change the game, know that this is exactly the kind of insight we share often. So take a moment and subscribe, so you keep receiving ideas that can transform the way you invest and protect your wealth. Most people limit international investing to foreign stocks. But there is much more: government bonds from other countries, international real estate funds, shares in companies paying dividends in strong currencies, commodity funds, and even infrastructure investments. Imagine owning shares of an Australian mining company that profits from global demand for metals, and receiving dividends in Australian dollars while your local economy struggles. Or investing in a real estate fund in Singapore, collecting rent from commercial properties in one of Asia's most stable markets. International investing is not about chasing every hot trend. It is about strategically positioning part of your wealth to ensure you have growth, protection, and financial independence. It is about preparing so that, no matter what happens in your country, you have income streams and assets in solid markets. When you think this way, you stop being just another passive participant in your local economy, and you become a player on the global stage. International investing is not just about making money, it is about buying freedom. Freedom to protect what you have built. Freedom to access the best opportunities in the world, wherever they may be. And freedom to live without fear that a local political decision or unexpected crisis could wipe out everything you have achieved. If you ignore this, you will remain dependent on a single economic scenario, hoping everything turns out fine. But if you act now, you can build a shielded portfolio, ready for any storm, and capable of growing even when everyone around you is shrinking. So the real question is, will you stay tied to one flag and one currency? Or will you start playing in the most powerful market there is, the world?